So starting to record. Okay, so I don't know if you guys have had a chance to watch Monday's lecture, but basically we're starting into, if you want to start a business, how should you set it up? And so we talked about 3 different options on Monday, one being the sole proprietorship, where you don't really set anything else up at all. It's very easy, but obviously it gives you personal unlimited liability. So it puts all your personal assets at risk. The second one was a partnership, basically 2 or more people associating with each other to own a business. The main advantage of a partnership comes from a tax perspective, where you can, each of the partners just recognize their income on their individual tax return. You don't have to worry about a separate one for the partnership. Then we did the LLC, which 99% of the time when people walk into my office and say, I want to create a new business, it's an LLC, because it's so easy. You don't have to be near as formal as a corporation, but you still get all the protections of being a corporation. But from a tax perspective, you get the easiness of being taxed like a partnership, where all the members of the LLC just recognize their income on their own tax returns, if they want to. You also you can choose to be taxed like a corporation. And I was telling them on Monday, first thing when somebody walks into my office and says, I want to set up a new business, I say, who's your CPA? Because we want to make sure with your CPA that we're setting up the best kind of business, and also that we're either choosing to be taxed as a partnership or a corporation, depending on what your CPA thinks. I put a disclaimer in everything I touch that I am not giving you tax advice. I know just enough to be dangerous and not enough to be informative. Yes. So I work with, and I have a good relationship with a CPA that if you don't have your own CPA, I call him and I'm like, this is not on the record, just bouncing this off of you, what would you set up? So if you want to set up a corporation though, they have their own chapter, and corporations, they're still a great tool. You just don't see them as much because they are formal. They do have formalities that you can accomplish with an LLC and not have to have minutes and meetings and, board of directors and all of that. So, but they are still very, very popular as well. So we'll just start into chapter 19 then. A corporation is a legal entity formed in compliance with the statutory requirements of its state of incorporation. So a legal entity formed in compliance with that state's requirements. So it is its own individual entity. That's the beauty of it. You sue the corporation, you don't sue the people personally. So number 1, 2, and 3 kind of talk about who's involved with a corporation. So number 1, the responsibility for the overall management of the firm is entrusted to a board of directors. And those people are elected by their shareholders, okay? So board of directors, they don't do the day-to-day. They oversee the overall management and, direction of the corporation. Number 2, the board of directors hires corporate officers and other employees to run the daily operations. That's when you hear of a CFO, a CEO. Those people are hired employees that work for the corporation to do the day-to-day stuff. Then number 3, when an individual purchases a share of stock in a corporation, that person becomes a shareholder and thus an owner of the corporation. Okay, so there's kind of your 3 tiers. Your shareholders own the corporation, even if they may own 1 of a million shares. They are the owners. Then they elect the board of directors who hires the corporate officers. Okay, so that's kind of a breakdown. Point A, under shareholder, the major advantage is that the shareholder's liability is limited to the amount of their investment. As you can imagine, when you invest in, the stock market, you're buying shares of a company. You are an owner of that company, even if you're a very tiny little owner, but still, you're not putting all of your personal assets at risk. You're only putting the amount that you invested at risk, and you're entrusting the board of directors to do with it what they will do to double, triple, quadruple your investment. But if they lose it all, they've only lost what you invested. Okay, so that's like the basic structure of a corporation. So earnings and taxation. Number one, when a corporation earns profits, it can either pass those on to their shareholders in the form of dividends. You've probably heard of dividends. Or they can retain them as profits. Okay, so the board's going to make decisions. Do we go ahead and distribute the profits? Distribute the our earnings out to our shareholders in the form of dividends, or are we going to retain them as profits? And here's kind of a breakdown of those. Point A, dividends. Those are corporate profits distributed to shareholders in proportion to their shares held. And I've got a typo there on the theirs. So it's distributed to the shareholders in proportion to their ownership. Point B is retained earnings. If they decide not to make those distribution of dividends, retained earnings are corporate profits that are not distributed to shareholders. And what they would do, the idea behind that is if they retain earnings and they reinvest those, then in theory, you're going to have higher profits to give to your shareholders in the form of dividends later on. So we're going to make some distributions, but we're going to retain some of the earnings, reinvest those, hopefully to give higher profits at a later date. So those are kind of, the two breakdowns of what we're going to do when a corporation does have some profits. Torts and criminal acts. Those should be words that ring a bell to you because we've already covered those. So number one, a corporation may be held criminally liable for the criminal acts of its agents and employees. So it may be held liable for the criminal acts of its agents and employees. So you need to hire and entrust your corporation to good people. Because obviously for a corporation to be held liable for something or be criminally liable, somebody had to do the bad acts. So again, they're doing it in the name of the corporation, so not personally, although we've all seen personal, board of directors and corporate officers go down for bad acts, but the corporation can too. And then number two, a corporation is liable for the torts committed by its agents or officers within the course and scope of their employment. I'm sure you've heard that before. Were you acting within the course and scope of your employment? A lot of times this is where you're going to see drivers of cars on company time making deliveries or whatnot, and they get in a wreck. Were they acting within the course and scope of their employment? Were they on a route? Or were they just using the car for their own personal doing off of company time? All stuff that you have to dive into to decide if that person is liable for what happened, or if they were acting in the course and scope of their employment, is the employer going to kick in and have their insurance pay for whatever happened? And that's point A. It's known as the doctrine of respondeat superior. Okay, RESPONDEAT. And then SUPERIOR, respondeat superior. It basically means, were you acting within the course and scope of your employment? And if you were, then the company is going to be liable for whatever you did, whether it was just negligent or it was intentional. The company's going to kick in because, again, hire good people because you can be liable for the stuff that they do. And I know that's the hardest thing. Especially right now with the environment, that's the hardest thing that you hear is it's just hard to find good help. First, that will show up, but just finding people that are skilled at whatever the job is that you need. Okay, any questions on those so far? I know I'm going fast, but we've got 3 pages of corporations. So classification of corporations, and I'm going to start this again so I can show you. Because I know that the class the other day found the Kentucky Secretary of State's website pretty interesting. So impressed, I remembered my password. I feel like we used to have to change it so much more often too. Okay, so when this kicks in, I'm going to go to Kentucky Secretary of State's website. This is where every company who's doing business in the state of Kentucky is registered. So if you want to form your company, or if it's formed somewhere else but you're doing business here in Kentucky, this is where you register to become a legally recognized entity, okay? So you can just Google Kentucky Secretary of State. You've probably heard about him a lot lately because he's in charge of elections, but he's also in charge of business filings. So when you get to their website, you go all the way down and you'll see search businesses. You would be amazed at all that is available to you by way of it being filed on the Secretary of State's website. I'm going to use my friend's dad's business just because I don't think you would care, and it's obviously all available. Chambers Roofing. They recently put a new roof on my house. Okay, so you'll see all the information about Chambers Roofing. Chambers Roofing Co. Inc., that's their formal corporation name. And you'll see here, they are a for-profit corporation, and I'll show you the distinction here in a minute. And they are a Kentucky corporation, meaning that they were set up in the state of Kentucky. They are active and they are in good standing because they filed everything annually that they have to with the Secretary of State. And you'll see they've authorized 200 shares to be given out as a form of ownership in their company, okay? And you'll see all of their filings down here. Here, dating back to 98, is the Articles of Incorporation, where their company was actually set up. And I know they've been around since like the 40s, but presumably this is when somebody passed and they're, cleaning up corporate documents, all that good stuff. And then you'll see with each year, you file your annual report where you pay $15 to the Secretary of State to basically give them updated information. Do we have the same principal office, any changes of anything? And that's how you stay active and in good standing. So keeping all of that in mind, let's talk about the different kinds of corporations. So number one is a domestic corporation. A domestic corporation is a corporation incorporated in a given state and doing business in that same state. So as to the state of Kentucky, Chambers Roofing is a domestic corporation because it's organized in Kentucky and it's doing business here in Kentucky. If you're doing business in other states, you go file the appropriate paperwork with those states, but you're not going to be a domestic corporation there. Chambers Roofing, because it's a Kentucky corporation, is a domestic corporation as to Kentucky. Okay? So on that same, in line with that, number two is a foreign corporation. A foreign corporation. That does not mean foreign country, which can be confusing. That is a corporation doing business in a given state, but incorporated in another state. Okay? And one I always love to show is Chick-fil-A. And I believe it's on the corporation. Just a second. Chick-fil-A. You literally can find out information about one of the biggest chain restaurants in the world, in the country. Chick-fil-A, Inc. It's a for-profit corporation, but look, it's a foreign corporation because it was organized in Georgia. Okay, so when it's in Georgia, doing business in Georgia, it is a domestic corporation. But as to Kentucky, it's a foreign corporation. Doesn't mean anything other than you know where it's organized, what laws it goes by, and you know that it's active and it can do business in Kentucky because it's set up the appropriate paperwork. And all it has to do, you'll see down here, is certificate of authority. Look, dating back to 1978. There's the certificate of authority to do business in the state of Kentucky. Now, obviously, that looks a little different nowadays, but you'll see then you've got every annual report. They are active. They are in good standing. all that good stuff. Yeah.
Do they only have to file annual reports in their home state?
No, you've got to file it everywhere you're doing
Every state
business.
you're doing business.
And I'll show you what it looks like. Yeah. Here is an annual report. It's a form that you literally fill out online, and you'll see that they pay $15. And they're just saying, principal office, still located where we say it is. Registered agent, remember that means who can be sued. If Chick-fil-A needs to be sued. And here's a fun point. Haha, not fun. But it has to be somebody located in this state. So every state they're doing business in, they have to nominate and appoint somebody to serve as registered agent. So if I want to sue Chick-fil-A because of harm they caused here in Kentucky, I don't have to go down to Georgia to do it. Because remember, long arm statute, they caused harm here in Kentucky. But in order to serve them, this is who I'm going to serve. And you'll see, this is a business. There is literally a business that charges you to serve as your registered agent in the state of Kentucky. So if you want to sue Chick-fil-A, you serve them, that gets you good service, then they will get everything to Chick-fil-A, to the appropriate parties, who will then file the answers to the lawsuit. And then you'll see you just list current officers, where they can be located, current directors, signed by the vice president, filed with the Secretary of State. You do that every year for any state where you're doing business. So obviously, the bigger the company, the more work you got to do. You know, the more, if you're all over the U.S., you've got a lot of corporate formalities to comply with in a lot of different states. Okay, and then number 3 is an alien corporation. An alien corporation. This is a corporation doing business in a given state within the U.S., but it's incorporated in a foreign country. Okay? It's incorporated in a foreign country according to the laws of that country. So that's what you can't get confused. When we talk about a foreign corporation, that's just another state. A foreign corporation is an alien corporation. Okay? And for point A, what I just showed you there, foreign and alien corporations may be required to obtain a certificate of authority from any other state in which they want to do business. So that's where I showed you they don't have to file articles of incorporation in the new state because they're already a corporation. They're just getting the authority to do business in those states. Okay, any questions on those 3 distinctions? All right, well then we'll keep going. So other classifications of corporations. So you've got your corporation set up, but there's another way that we can also distinguish them. Number 1 is a public corporation. A public corporation. This is a corporation formed by a government to serve some purpose. This is the post office. The post office is a public corporation. So it's nothing that somebody went and set up, I'm going to incorporate the United States Postal Service. No. It's a corporation that the government sets up to serve some type of purpose. But you can still find their information. Number 2 is a publicly held corporation. A publicly held corporation. This is what you hear about on the stock market. This is what you hear about where shares are being traded. It's publicly held, meaning people that you don't know can have ownership in your company. Okay, so defining it then, this is a corporation whose shares are sold to and held by or on behalf of the general public and are traded on a public exchange. This is Facebook, this is Apple, this is Amazon. They don't know who all of their owners are because their shares are being traded and sold and held by the general public. Even if it's one of a million shares, they're being held by the general public. They don't, it's nothing like a family-owned business, okay? That's a publicly held corporation. That's what you hear about on the stock market. Number 3 is a private corporation. This is Chambers Roofing, okay? This is a corporation formed by and owned by individuals. I think my copy says owed by. I was on a streak of typos on this. That's owned by, not owed by. A corporation formed by and owned by individuals and other private interests. So these are the companies that an individual sets up, not to be publicly traded on the stock market, but to set up a corporation for their own family business or whatnot. So point A there, we sometimes call these a close corporation, CLOSE, meaning this is a privately held corporation with a small number of shareholders, often members of the same family. Okay, so so it's a private corporation because you're not traded to the general public on the stock market. But 9 times out of 10, these are going to be close corporations where it's family members setting up a company. Like Chambers Roofing is 2 brothers, Mark and Joe. And again, I'll just tell Mark later that I've used him as an example. Maybe you guys will think of him someday if you need a roof. But yeah, so they're a close corporation. They're owned by 2 brothers. So they're a private corporation, but also kind of considered a close corporation. And little point I there is just the letter S, an S corporation. This is a closely held corporation that is taxed like a partnership while affording its owners the limited liability of a corporation. What this means is, if you meet the string of requirements, then you don't have to be taxed like a corporation where it gets its own tax returns and has its own requirements. But there's certain times where you can be taxed like an S corporation, meaning those shareholders who own that corporation, because there's probably only a couple of them if they are a close private corporation, they still may be able to recognize the income on their individual tax returns rather than doing full-blown taxes, through the corporation. Again, nothing I'm going to get into, and there's a lot of requirements to meet, but even when I set up LLCs, that's where I say, okay, there's a couple of members. Do you want to be taxed like a partnership or an S corp? Again, I don't know the formalities. The CPA tells us what would be more beneficial. But there are some ways when you're such a small corporation that they can get around it and still try to get you taxed like a partnership. But you still get the protection of being a corporation. Because remember, at the end of the day, the whole purpose of setting up a separate entity is to protect your personal assets. If you're running a roofing company and you mess up, well, that's a pretty significant amount of damages that you could do. I don't want my own personal house and my own personal retirement and my savings accounts and whatever on the line. I want the company's assets and the company's insurance to be on the line. And then number 4 is a nonprofit corporation. I'm going to show you one that I'm really involved with, that I actually set up. And it is the Police Foundation. So the Police Foundation of Paducah, McCracken County, Inc. It is a corporation. It is set up to raise money to support the Paducah Police Department as a nonprofit. And that's what you'll see here is different. Is we're telling the world this is not a for-profit corporation that's, making money for its shareholders. It's a nonprofit, but it is still a Kentucky corporation. You'll see down here, we still file our articles of incorporation. We incorporate just like a normal corporation would, but we don't have shares. We don't have shareholders. We still file our annual report. We still have to be active and in good standing. But that, you set up your nonprofit because there's various tax benefits you can get, as I'm sure you guys have ever known. Make a tax deductible gift. Okay, well, if you do it to a nonprofit corporation, you get the tax benefits of that. And that's because it's organized as a corporation, but then under the tax code, it's a 501c3, meaning donors will get the benefit of a tax deduction whenever they make a donation. But for all intents and purposes, it's still a corporation organized under the state of Kentucky. It's just denoted as a nonprofit. So defining a nonprofit then, this is a corporation typically formed for charitable, educational, religious or similar purposes, and organized and operated without the goal of making a profit. Okay? So it's really, you'll see in these nonprofits, in their articles of organization, it's a very broad paragraph of what they're going to do, because it's really easy to fall into an educational or religious or whatever type of purpose. You just have to, make sure you set it up the right way. But the main thing is you're not operating to make a profit. That's what differentiates you. Any questions on classifications? No? Okay, so how do you incorporate? I've showed you a lot of this. But first, you need to select the state where you want to be incorporated. Select the state where you want to be incorporated. Point A there, before I explain this anymore, Delaware is a popular choice because of its corporate laws. And surely you've heard that. A lot of your big companies, even if the mastermind behind it lives in Arizona, they're probably going to set it up as a Delaware corporation. And that's fine, because then they'll just, get certificates of authority to do business everywhere else. But there's no benefit to Chambers Roofing organizing under the laws of Delaware. They're not going anywhere except the state of Kentucky. But when you're thinking of going global or going worldwide or going even, nationwide, some people consider Delaware. But you select the state where you want to be incorporated. Then number 2, secure an appropriate corporate name. When anybody calls me and says, I want to set it up and I want to call it this, first thing we do is we search the Secretary of State's website to make sure it's still available. So point A there, the name must neither be the same as nor deceptively similar to that of an existing corporation. This is taking out all concerns of trademark, patent, all that good stuff. This is just, it's got to be distinct enough from anything else in that state to be its own distinct business. And I've seen, what was the one? I mean, you can usually just add like of Paducah or of McCracken County. If it's whatever that's similar to, taco bar, and that's somewhere else, you could probably just do taco bar of Paducah. And you may have trademark concerns. Secretary of State's not worried about that. They're just trying to see that it's, different enough from another one. But usually you can just change it up just a tiny bit and it's fine. So then number 3, prepare the articles of incorporation. Articles of incorporation, that's what you were looking at for Chambers Roofing and for the Police Foundation. So point A, that is going to include the corporation's name, the number of shares, and the names and addresses of its registered agent and its incorporators. What we typically do when a corporation says, I want to set up as a corporation, we usually authorize, if we know they're not going to Wall Street, we usually authorize 1,000 shares. You don't have to issue all of those. I can have 100, you can have 100, and we can be the only owners of our company. It just means if we want to get other people involved, we can issue up to 1,000 shares. You'll see that Chambers Roofing had 200. I don't know this. I don't do their legal work. Guarantee you, Mark has 100 and his brother Joe has 100. They've issued those shares. But it just represents your ownership in the company. And then, of course, obviously, you have to have your registered agent, their name and address, and then who is actually setting up the company. Number 4, you got to file the articles of incorporation. So those are only seen on the Kentucky Secretary of State's website because you guys, those people filed them. That's what gets you organized. Congratulations, you're a new entity. After that, you got to do some more corporate formalities, though. Number 5, after incorporation, the first organizational meeting must be held. So you have to have a meeting. And what you do at that meeting is point A, you adopt bylaws, which are the corporation's internal rules of management. So the articles are basically, the articles set you up. They form you into a corporation, but they really don't dictate much about how the company is going to be run. Your bylaws do that. They say when you're going to meet. They say, how many people you're going to have on your board of directors. They say how you're going to elect officers. What officers are you going to have? They talk about actually running the company. That's what makes a corporation a lot more formal and a lot more work than an LLC. An LLC doesn't have to do all of those things. It can, but it doesn't have to have a board of directors. It doesn't have to have shareholder meetings. It doesn't have to do any of those things. And it's really why a lot of people pick the LLC anymore. But a corporation, many companies that were already formed a long time ago, they're set up as corporations and they operate that way. But the bylaws are they're not a public document that you put on the Secretary of State's website. They are your internal rules of how the company is going to operate. Once you do that, you're an operating corporation. And it doesn't take Mark Zuckerberg to set up a corporation. I mean, everybody that does any type of work is organized as an LLC or a corporation. They don't have to be that complicated to run. You just really have, what I tell people, when in doubt, just write it down. Write down what you did, put it in your minute book, and we literally give a corporation a binder. We say, here's your minute book. Anything you do, any resolutions, anything you do, put it in the minute book, and you've got proof of when it happened and that everybody, said it was okay to happen. So, piercing the corporate veil. I don't know if you guys have ever heard of this, but overall, and I'll define it in a minute, basically, in order to have the protections of a company, you got to be operating a company. You can't have just this shell company over here and get its protection if you're not treating it like a company. If you don't have its own bank account, if it doesn't have its own insurance, if it has zero money in its bank account, you could still maybe be on the hook if you're not treating it like its own company. And that's called piercing the corporate veil. Because you think about the veil providing protection of all the people who are personally involved, they can get through that if you're not operating like a company. So number one, a plaintiff may be able to pierce the corporate veil when the courts disregard the corporate entity and sue the wrongdoers individually for actions they took as owners, officers, directors, whatever their capacity was. If they were a wrongdoer and you guys weren't treating this corporation or this LLC or whatever your business entity is, if you weren't treating it like a separate one, there is still some chance that plaintiffs can get to you on an individual level. Now, again, if you were doing it, they can still try to sue you individually, but if you can prove you were doing everything you had to do to run your corporation, you're going to get that protection. But it doesn't mean they're not going to try. Because they're going to try to get, compensation from anybody and everybody they can. But if you run your company like a company, maintain it as its separate entity, you're going to have those protections. Have your own bank account, have your own insurance, have your meetings, have your minute book, have money in that bank account. Do everything in the name of the company, not your own personal name, and you're going to get that extra protection. Point A, too, this occurs when owners or officers or directors used a corporate entity to commit fraud or other illegality. So sometimes it is intentional, like we set up a sham company and did nothing with it, and that was for the intent of deceiving everybody or defrauding them. Sometimes it's just that you didn't do what you were supposed to do because you weren't working hard enough at it. At recognizing the corporate formalities. And so it doesn't just have to be because you were trying to commit a fraud. Sometimes it is, but a lot of times it can just be because you didn't do what you're supposed to do. Okay, directors and officers' duty of care. So remember, you have a board of directors, but then you've also got the officers that they hire. And within the board, let me back up. You've got your board of directors who oversees the overall management. They elect officers. They've got a president, vice president, secretary, treasurer. Those are of the board. So they're overseeing the overall management, but then it's the people you hire, like your CFO, your CEO. Those are your corporate officers. Those are chief executive officer, chief financial officer. Those are hired by the board. So what kind of duty of care do they owe? The standard of care generally requires a director or an officer to act in good faith, meaning honestly, to act in what he or she considers to be the best interest of the corporation, and to conduct reasonable investigation before making a decision. Very broad, right? And very, very gray. But you have to act in good faith, in the best interest of the corporation, and do a reasonable investigation before you make any decision. That's the case with anything. If you're not acting honestly, it's going to be bad. If you're not doing any investigation, you're just making a decision on the whim, obviously that's going to be bad in any sense. But that's the duty of care that's owed to the corporation. So number 1 there is the business judgment rule. The business judgment rule. Basically what this means is a director or an officer will not be liable to the corporation or its shareholders for honest mistakes of judgment or bad business decisions made in good faith. You decided to make that investment into a second facility. After 4 years of your due diligence and your investigation and whatever, and then COVID hits and it goes south and the company goes bankrupt and the shareholders lose everything. The business judgment rule says that as long as you did that in good faith with, reasonable investigation, you thought it was in the best interest of the company, those people who made those decisions are not going to be liable to their shareholders or to the corporation itself when it goes south. Because sometimes decisions just turn out to be bad business decisions. And we don't know what's going to happen. We don't know a global pandemic's going to hit when we've opened our second location that cost us $30 million. Things like that happen. So, officers and directors, they can serve on these boards and have the protection of knowing that if something they decide turns out bad, they're not going to be personally liable to those individuals because they made a bad judgment call. But it's why you have to do all the reasonable investigation. In line with the duty of care is the duty of loyalty. That requires directors and officers to subordinate their personal interest to the welfare of the corporation. So subordinate your personal interest. Don't compete. If you're involved with one company, don't compete with the other. You have a duty of loyalty to this company, and your personal interest, in theory, need to be set aside so you can make the best calls for this company. And then last but not least, the shareholder. So it can be 2 shareholders, it can be 2 million shareholders, just depending on if it's a public or private corporation. But don't forget, the shareholders own the corporation, but they generally are not responsible for its daily management. So you own the corporation and you buy into it based on your own comfort level of that company having a good board of directors and corporate officers to make good decisions. But again, your liability is only limited to the amount of money you invested in that corporation. So number 1, shareholders meetings must occur at least annually. And again, that's another corporate formality that obviously LLCs do not have. So the shareholders meetings must occur at least annually. And if you have even just 1 share in a company, you're going to get notice of a shareholders meeting that you're never going to attend. But they have to occur at least annually. And number 2, the law allows stockholders or shareholders to either vote in person or appoint another person as their agent to vote their shares at the meeting. So again, your vote obviously is going to be in proportion to the amount of shares that you have. So if you can go in person, you can vote, or you can designate an agent. And that is called, that point A there, a proxy, Proxy. That is the agent's formal authorization for somebody else to vote their shares. Somebody sends their proxy, that person can vote their shares. So overall of a corporation, play around on the Secretary of State's website. It's pretty interesting. And you'll also see every, say you just put in, will this come back up if I just do this? Say you just put in a very vague word. Let's see. If you just put in the word police, you're gonna find, look at that. Everything. Police, what did that one say? say Police Donuts LLC. There's a My Police Foundation, Police Holdings, Police K9 Magazine. All the green ones are businesses that are active and still in good standing. All of these are inactive or in bad standing. It could be inactive because they decided to dissolve. They've dissolved their corporation, wrapped up their LLC, they're no longer active. Or it could be they haven't been filing their annual reports. And the scary thing is if you're not doing what you're supposed to do as part of the corporate formalities, if you're not filing your annual reports and you're inactive and you're in bad standing, you run the risk of losing that protection of a separate corporation because you're not treating it as a separate corporation. You're not abiding by the formalities. So it's just one more thing to make sure you do. But the Secretary of State's website makes it really easy because they send you notices. They send you a little postcard. You fill it out, pay the $15, mail it back, and then they put it on the website. So it's not a hard thing to keep up with. So any questions on corporations? No? Fun stuff. I've actually set up some stuff for former students. When they've graduated, I had one that went into the heating and air business. And so he called and we set him up one and it's fun to see. I was like, oh good, you remembered that you didn't just need to be doing that in your own name, especially when you're working on people's houses. And that's kind of what we talked about. Sometimes what you're doing, there's no risk. Do it on your own. Don't set up another entity, whatever. But the riskier the job, the more protection you need. And it's just, especially an LLC, that's what people say. Should I set this up? It's just too easy not to set up and to manage, to not have that extra protection that it affords you. It's just too easy. And I think in hindsight, people would be kicking themselves if they didn't set it up. Okay.